What's up, my people? Welcome back to Option Science channel. Today is 10th of November, Thursday, and Thursdays happen to be weekly expiry in options. So I want to talk to you about a few things regarding the expiry today. As you can see from the chart, expiry was a volatile expiry. There was complete sell-off in the first half of the market. The market was coming down, and then there was a complete rally towards the upside, and Bank Nifty closed around at the same point where it opened. So it was a complete V-shaped V recovery volatility, and it was pretty volatile. Now, one important thing to notice is that if you see the levels of India VIX, so India VIX is the factor which determines the volatility in the market. So if you see India VIX at the daily charts, it is at the lowest level possible, and prior to this, it was a high VIX environment. All these areas was high VIX environment where the VIX was above 20. VIX indicates the volatility, right? Even though the VIX is low, it was pretty volatile expiry today. So VIX will give you the implied volatility, wherein the actual volatility or the real volatility is what we observed in the market. So implied volatility and actual volatility are not matching at the moment. So it was a pretty volatile expiry. So we'll just go to Zerodha and see how we have performed today. We have booked around a profit of around 32,000, which is around 1.6% of the capital. So that is about the profit side, and let me take you through my trades. So initially I was in a straddle for 41,600, around this range, and close to around 1.5 to 2,000 profits I had booked in the straddle. And since Bank Nifty started coming down continuously, I exited my straddles and went into strangle positions for far OTM puts and calls. So initially I had gone to 41,300 puts and 41,700 calls. So gradually as market came down, I started moving down my calls first to 41,600 levels and then to 41,500 levels. Also, I had shifted down my puts to 41,300 to 41,200 levels. So there was an instance wherein a complete spike had happened, and I was unlucky to exit at a bad price. I'll show you in the charts also. Precisely, if you see this particular candle, it was around 12 p.m. That candle, when it came down, actually I think I was on 41,300 puts, and let's see the charts for 41,300 put. Yeah, so we'll go to 5 minutes chart, and as you can see clearly at 12, so this is the candle we are talking about. So we can see at 12 what happened was that put premium, which was at around 19 to 20 rupees, spiked to around 42 and 43 rupees in a single candle. So this is that particular candle, and I was unlucky to get knocked down or exit at the highest point possible. I exited at 43. Like in 1 second or so, the spike happened so quickly, and when I executed the order in market order, it got hit at the highest point possible, and just within a fraction of second it came back to the levels of around 32. So I got exited at around 43, and 10 points I lost drastically there. So that is one unlucky thing which had happened to me. And further to that, I had moved my calls down from 41,600 to 41,500. Also my puts I had moved from 41,300 to 41,200. And from here market was sort of recovering and started going up. So after the first half, as soon as the European markets and everything opened, market started making the up move. And very interesting thing which has happened is that at one particular point of time, 41,500 had open interest of around 1 crore contracts. Okay, around 1 crore call writing was seen at 41,500. So it was pretty sure to be acting as a resistance, but to the surprise of everyone, I think for the surprise of entire option writers in the market, this 41,500 was taken out, and I remember seeing 41,500 calls at around 11 rupees spiking up to 107 rupees. So those who had bought 41,500 or any strikes 41,400 or any such strikes during the up rally would have made considerable amount of money, because it was just a brutal expansion for call side. So this expiry again proved that open interest or the call writing or put writing which we see at the levels are never to be trusted completely. Of course, these are just the conviction of the players in the market, and even though a big percentage or the majority of the people have the same conviction, market can still go against that conviction and break all of their convictions as well. So this is sort of a learning which has happened in the previous expiries also. We have seen many a times where in open interest resistance or supports are not being respected by the market. So all in all, market is the supreme authority. We cannot decide market movement by any factor. Only thing is we can take an informed direction, or like more probable direction, which need not be respected all the time. So that is that. And from last 2-3 expiries, what we have observed is that after 230, 245, the moves are very brutal. So at around 3, the movements in Nifty, especially if you see Nifty candles after 3 o'clock, are very huge candles, and also subsequently Bank Nifty also follows that. So it's better to avoid trades after 245. I personally exited all my trades around 245, and it is just to protect my profits, or else you wouldn't have enough premiums from one side to adjust if the opposite side starts spiking. So it's better to avoid trading after 250, and I personally exited all my trades at around 250. And given how the day has gone, a V-shaped recovery and huge volatility in the market, I'm happy that I could end up with around 1.6%, which is decent, and that is how my expiry has gone. So the idea remains clear. We will start off with straddles, collect as much DK as possible during the initial hours wherein premiums are much higher, and towards the progression of the day where the DK starts to kick in, we will go into far OTM calls and puts, and will sit safely there, and we dance according to how the market moves, right? If the market moves down, we will shift our put and calls. If market moves up, we'll shift our put and calls again. So clearly non-directional, and if there is any drastic movement up and down, those are the days when we are sure to make a loss, because nobody can adjust that fast against the market. If at all we adjust and the conviction goes wrong, like when we adjust, the market moves in the opposite direction, again we are bound to take those losses. So market is all about a mix of arithmetics, probability and conviction, plus a luck factor is also included. Like I showed you in the example today, had I exited this candle maybe 1 second after, I would have saved around 10 points there. But nevertheless, that is the nature of the market. Will sometimes be lucky to you and sometimes be unlucky to you. So that is that, and as a trader we sign up for these kind of uncertainties and these kind of risks. So at any given day I will take it. So that is how my expiry trade went. I hope you all had a nice and decent expiry. I'll keep on posting videos about my trades and trading styles, and I'll keep you posted about my progress as well as the setbacks I am facing in my trading journey. I hope you all can relate to the content and take back something as a learning from the videos which I am trying to post. I wish you all the best. We'll see you on the next video.